Hello and welcome to Radio Pete's Wealth Talk. My name is Pete Williams, the host of the program on which we talk about all things wealth. Clearly, there is a lot of things going on these days. I'm recording this on Thursday, July 28th. Just yesterday, we got word from the Federal Reserve Board that they're going to target the Fed funds rate at a 0.75% higher, trying to raise rates to beat down in the inflationary effects in the economy right now. Just today, on Thursday, July 28th, we got news that the second quarter of 2022 was a negative GDP read. That makes 2 quarters with negative GDP. That traditionally was a definition of a recession. But there's some debate about whether it really is or not until a bureau comes out and tells us we have a recession. We can't really say that we do. The argument is that employment numbers are strong and spending is still relatively strong, and it really doesn't reach the definition of a recession quite yet. So, and if that's not enough, we also, of course, earlier in June, entered a bear market in stocks in most of the major indices. S&P 500, Dow Jones, and certainly the NASDAQ came down 20% below a recent high. They've been bouncing back. We've had a phenomenal market the past couple of days, but today I'm gonna talk about the yield curve, and in particular the inverted yield curve, what it is, how it happens, what does it typically mean for the economy, and what it typically means for the stock market. First, let's talk about a regular yield curve. The normal yield curve is upward sloping. And for time periods of a note or a debt or a bond that are short in duration, say a 2-year note, typically the yield on that, the interest charged or paid, is lower than a bond or debt of a longer time period. And when you think about that, if I were to lend you two amounts, I was going to lend you $100,000 for a 2-year period, and then I was going to lend you $100,000 for a 10-year period, typically I would charge you less for the 2-year note and charge you more for the 10-year note, because my risk in lending you the money is substantially more in a 10-year note, whereas in the 2-year, there's certainly risk that I don't get my money back, or there's a risk that inflation is not as expected, but there's a certain clarity in a 2-year period where there's not in a 10-year and beyond. That's why typically you're going to have higher interest rates on longer term yields. And when you think about this, what this really means is that it's an optimistic view towards the future. It means there's going to be growth. There's going to be moderate inflation. So we need to be compensated for lending money out the longer term, because there is going to be a positive economy, positive growth, and yes, positive inflation. So you would typically have charge more in that longer period. But every once in a while, it's not the case. So we'll see that in a moment. We are typically talking about U.S. government debt. And then U.S. government debt does a couple of things. One, it takes out the default risk. In theory, and we hope in reality, there is no default risk no matter how long a period the government debt. Whereas on a personal loan, the more time you lend money out, the more you have to worry about not getting that money back, that your borrower doesn't pay you back. When it comes to the U.S. government, we hope and pray that the U.S. government will not default on its debt. So that takes out the default risk. Also, the U.S. government market is very liquid. Government debt is easily bought and sold in the market, and in the absence of any interference, I'm referring to the Federal Reserve, there's a very easy price discovery. We know what a bond is worth in the marketplace typically, in the U.S. government debt, whereas a personal loan, who knows what it's worth because of the risk factors and other things. So we're usually talking about government debt, and we're normally comparing the 2-year note to the 10-year note. Now, you should know that if you do an internet search, you want to be a little cautious, because in the past, there have been comparisons, the 10-year to the 1-year. And just to stick to apples with apples, just know that I'm going to use what most people use today, and that is the 10-year to the 2-year. And we're going to compare those two different yields. Again, normal curve says that the 10-year is going to pay more than the 2-year. An inverted yield curve is going to mean that the 2-year is higher in interest than the 10-year. And the Treasury puts out numbers on the yields. And this is the month of July. I just picked this right out of government figures. And what we want to do is hone in on the more recent numbers of July 27th, and we want to take a look at the 2-year compared to the 10-year. And just looking at this here, we started off July with sort of a flattened yield curve, where the 2-year and the 10-year were very similar. And then the spread started to invert by a little bit at first, 0.04, 0.02, 0.03. And then all of a sudden we get the July 11th jump up to 0.08, 0.07. And then we get into double digits, where we're quite a bit more, 0.22. We're at 0.21. And so the yield curve's even. Now, what you're going to notice about an inverted yield curve, it's not exactly the opposite of a normal yield curve. It doesn't mean that that short-term rates are much higher than long-term rates. Although you're going to see that did occur back in the 80s. It really doesn't take much to call an inversion and to have the effects of an inversion show up. It's really in small amounts, and it's really a flattening of the yield curve. And then ultimately, when the short term sneaks up above the longer term rates by a little bit. But here we are down on yesterday's close in the markets. We had the 2-year note at 2.96 and the 10-year at 2.78. So what do we got there? 0.18 difference. Again, it may not sound like much, but the very fact that you've got higher rates on the shorter term than the longer is significant, and we'll see that. So here we are, July 27, 2-year at 2.96, 10-year at 2.78. If we take these numbers, which I've gotten from the Department of the Treasury, you can just go right to their website and pull these on a daily basis, by the way. What it looks like is like this. As I mentioned earlier, it's not so much of a drastic inversion as it is a flattening with a slightly downward sloping curve, where we have our 2-year at 2.96 and the 10-year at 2.78. And so we can see that there is an inversion here, and which is somewhat unusual. And we're going to take a look now at what that might mean. If in fact the normal yield curve suggests, as some people do, suggests that we're in a positive economic environment, that we're expecting moderate inflation, not drastic inflation. We are hopeful about the future. The economy looks good. Then an inversion says perhaps something else. It may be saying the fact that a lender is paying more on short-term debt, that borrowers are demanding more on short-term debt than longer term. It may actually mean that the opposite is true, that there's a negative outlook on the horizon. And that's explains part of the reason why this negative yield curve sometimes some people suggest predict bad economic times ahead. So once again, how did this inversion happen? It could be just a negative outlook on its own. But of course, added to that is we've got Federal Reserve policies. As of right now, we've got a very high rate of inflation. Last print was over 9%. We've got a Federal Reserve that is dedicated to bringing that inflation rate down. One of their tools that they use is to raise the short-term interest rates, to try to bring the cost of funds down, to try to bring literally economic activity down to fight off inflation, because the standard definition of inflation is people have a lot of money and they're out there spending it and causing prices to go up. And the more they spend, the more prices go up. The Fed is trying to rein in ever so slightly, ever so delicately, that sloshing around of free money that, by the way, some argue they have created by free money policy, both on the Federal Reserves as well as the fiscal policy of the U.S. government. And so we're sitting here with high inflation, and the Fed is driving up short-term rates in which they hope will bleed into longer-term rates. In fact, just today, I read where the prime rate, most of the prime rates at the major banks are going up. So it's having its desired effect of sort of trickling up to the longer term maturities. Why is it important? Certainly every recent recession has been preceded by an inversion. And it looks like this is bearing out. Remember what we saw. We saw that the inversion occurred back in July. And lo and behold, we have another negative print of GDP. So that inversion may have foretold what the economy is doing and may do in the future. So some suggest that it's worth taking a look at and paying attention to these inversions. And by the way, there are some false positives here. Every recession is preceded by an inversion, but not every inversion leads to a recession. But in recent history, it's been pretty accurate. This goes all the way back to the 70s. And this is the historical 10-year to 2-year spread on the treasury yield. This is the zero line. This is when the yield curve inverts. And back in 1980, it actually got to a full 2 percentage points, 200 basis points, whereas right now we're sitting at 0.18. It was 2.00 difference between the 2-year and the 10-year. So quite a significant. But this drop, this inversion, foretold a recession coming, and sure enough, in early 1980, a recession did occur. Things looked like they were getting a little bit better. But then there was another inversion later on in the 80s. And then there was a severe recession back in 82, just a couple of years later. This is considered a false positive. The amount of time between an inversion and a recession is varying, as you can see. Sometimes it's immediate. Sometimes there's a lengthy time, up to 1 year, 18 months. Here we had an inversion, went back to positive, another inversion, recession. We in the mid 90s, we came close to inversion, bounced off of it, inverted, had a recession. In the 2006-07 period, we had an inversion, recovery, inversion, and then a recession, what we call the Great Recession of call it the 2007 to 2009 time period. So it's been fairly accurate, especially in the past 40 some odd years. And here we are today. We've got an inversion. And now the question is, are we going to have a recession? Today, with the negative GDP print, it suggests that we are going to have a recession. And now the question is how long and how deep, and what will the Federal Reserve do about it? You may want to go back to my podcast about the Fed put. The argument has been that anytime we have a little bit of a scare of a recession or a stock market decline, that the Federal Reserve will reverse and start easing on the monetary policy, and they won't go through with battling inflation, and they'll back off. Once again, this time the Fed says they're serious, they're going to choke off inflation, and we shall see. So here is the actual U.S. interest rates over time. Remember, the previous graph was tracking the difference between the 10-year and 2-year, and now we're graphing the Fed funds rate, the actual Fed funds rate that the Federal Reserve is now trying to target, and now is trying to raise back up. And you can see historically, particularly coming into the 70s and 80s, rates just took off like a rocket, and rates rose, recession occurred. Rates rose, recession occurred. Rates rose, recession occurred, and so on. Sometimes there's a lagging effect, but typically when Fed funds rates go up, it's followed by a recession. And that, in a way, is what the Federal Reserve is trying to do. They're trying to raise rates to the point of choking off inflation, but not driving us into a deep recession. They just want to slow down inflation. Incredibly, back in 1980, Fed funds rate was up to 20%. That was the Volcker years here, where Paul Volcker, as a Fed chairman, came in and just kept raising Fed funds rate to choke off inflation, and it worked. And then since then, you can see that there's been attempts to jumpstart the economy and raise rates back up. They failed. Jumpstart, fail, jumpstart, fail, and then of course we got down to near zero to jumpstart the economy. Tried to raise them back up, and that failed. So this is all the big debate right now: is are we going to be successful in raising rates without driving us into a severe recession? And this is what you're going to hear about: the Federal Reserve and its loss of credibility. If you go back and take a look at my podcast on the Fed put, the Federal Reserve has historically backed off and provided relief once it gets a whiff of any kind of decline, any kind of weak economy, and they don't have sort of the Volcker mentality of choking off inflation at whatever cost. Paul Volcker certainly believed that there's nothing worse than inflation, and nothing worse than getting into an hyperinflationary environment. So he dedicated himself to choking it off. Recent Fed boards have been a little bit quick to lower rates, but very slow at raising rates, and very cautious. So in that regard, that's what we mean by loss of credibility among the Fed board. They talk a good story about choking off inflation, but when it comes right down to it, they're going to rescue the stock market. Let me back up. They have rescued the stock market and the economy and allowed inflation to run. That's the argument. That's the argument for the loss of credibility of the Fed. And here's just a recent past here. The more recent past, 2019, the Fed was trying to raise rates, and then suddenly in the summer of 2019, now this is before coronavirus. There's no COVID on the horizon here, but there was some bad numbers that came out on employment, and arguably, some would argue that the Fed was a little bit too quick to act. In a sense, the Fed doesn't have the faith in free markets and capitalism to solve these problems, and they feel like they have to come in and jumpstart the economy. And they did that starting in July of 2019. They started lowering rates, and the economy was fairly strong at that time. If you go back and take a look, there were some fears of lower employment figures, higher unemployment figures, but nothing real severe. But they were very quick. They see the economy going, and then they see a little bit of slow economic growth or higher unemployment, and they feel like they have to kickstart. And certainly by the time March of 2020 came around, that's when COVID was around, and unemployment became very high, and a lot of problems with productivity and many other things. And clearly they had to drop interest rates during that time. But remember, they had already started the decline well before that, and arguably they didn't leave themselves with much ammo. And that's when the federal government came in with its bailouts, its packages, its money. The printing of money happened here, and the Fed just kept rates right at zero. And now they're trying to raise them back up. This only goes to June 15th, last month, where they raised the targeted rate for Fed funds is now 1.5 to 1 3/4. So now the target rate is 2.25 to 2.50. And we'll see. We'll see. It's going to be interesting to see what the prints are for the inflation figures. So here's the big question. We have an inverted yield curve where short-term rates 2 years higher than 10-year. We have a bear market, and arguably we are at the beginnings of a recession. We may be able to get out of this, but the Fed is going to keep trying to dampen down inflation. And people are trying to second guess. Yeah, and it's a dangerous guessing game right now. Will the Fed do what it's done in the recent past, and that is back off, start lowering rates as soon as things start looking bad? In fact, arguably after today's print on GDP, the market has gone up yesterday a good 1.5%, 2%. Today, another 1%. There are those who suggest that the worst is over. The Fed is going to once again cave in, stop raising rates, and rescue the stock market, bring out their Fed put. There are others who say, be careful. This is a bear market rally. And it is the Fed has to act this time. They cannot keep doing what they have done in the past. We'll see. I'll keep providing updates on this very topic because I think it's important. I'm ending this podcast here, but what I want to talk about next is inverted yield curves in banking. And just real quick, to give you a hint of what my next podcast is going to be, banks borrow short and lend long. So normally a bank would like to pay 1% on a savings account and then lend that money out at 5% on a mortgage. But that 1% savings account maybe has a term of maybe 2 years, whereas the mortgage has a 30-year. So clearly banks love regular yield curves. They do not like inverted yield curves, because inverted yield curves means that their profits are squeezed. They live off that spread, and those spreads become negative, where if they have to pay higher than they're lending at, that's bad for banks. So I'll talk about that. I'm going to talk about the how banks actually work and what it means when loan activity declines. So stay tuned for that. I'm going to continue this topic about the yield curve, about the Fed actions. Next up is the inverted yield curves in banking. I want to thank you for joining me. We'll see you next time on Radio Pete's Wealth Talk.